Most beginners think they're investing the right way, but what if they're getting it completely wrong? From chasing quick profits to following random advice online, many people start investing with the wrong mindset and strategy, and it ends up costing them. The truth is, successful investing isn't about luck or timing the market. It's about doing the basics right from the start. In this video, we're exploring why you're starting investing the wrong way, and what you should be doing instead to build real, long-term wealth. Today, we will talk about your starting investing the wrong way. So before we get started, make sure to hit that like button, also subscribe to my channel. 10. Investing without education. Many beginners start investing without understanding the basics. They hear about stocks, cryptocurrency, or real estate and jump in because they want to make money. But they don't know how these markets work, how to read charts, or even basic terminology. This is dangerous. Investing without education is like driving a car blindfolded. You're bound to crash. Even a small amount of learning, like understanding risk, how investments grow, and how markets move, can prevent costly mistakes. For example, imagine someone buys a stock based on a friend's recommendation. The stock drops 30% in a week. If they understood the company's fundamentals or the market trends, they could have avoided panic selling and made a rational decision instead. 9. Chasing trends and hype. A huge mistake is investing because something is popular right now. Beginners often see trending stocks, crypto coins, or hot funds and jump in, thinking they will miss out. The problem is that hype usually inflates prices, and early excitement often leads to quick losses when the trend cools off. For example, cryptocurrency booms attract a lot of newcomers. Many buy coins they don't understand at high prices, only to see the value drop drastically. They panic sell and swear off investing altogether. Smart investors don't chase popularity. They analyze fundamentals, long-term growth potential, and market stability before investing. They evaluate whether the trend fits into their overall financial plan. 8. Ignoring risk management. Many beginners focus only on potential profits and ignore risk entirely. They put all their money in one stock, one crypto, or one real estate project. If it fails, they lose everything. Risk management is crucial. Smart investors diversify their portfolio, allocate money according to risk tolerance, and prepare for losses. For example, if you have $10,000 to invest, putting all of it into one high-risk tech stock could be devastating. Instead, splitting that money across low-risk bonds, stable dividend-paying stocks, and a small portion in higher-risk assets balances potential gains and losses. 7. Expecting immediate returns. Investing takes time, yet many beginners expect instant results. When they don't see immediate profits, they panic, sell too soon, or switch investments repeatedly. True investing is a long-term game. Even steady stocks or index funds need months or years to show real growth. Expecting instant success leads to frustration, impulsive decisions, and losses. For example, someone might invest $1,000 in a growing company, watch it drop 10% in the first month, and sell immediately. Over time, that stock could have doubled or tripled in value. The mistake was impatience, not the investment itself. Understanding that wealth grows slowly and steadily allows you to ride out market fluctuations, which is essential for success. 6. Not having a financial plan. A critical mistake is investing without a plan. Beginners often start randomly, without knowing how much to invest, what their goals are, or when to exit. Without a plan, every decision becomes guesswork. A simple financial plan defines your goals, investment horizon, and strategy. It gives you structure, focus, and discipline. For example, if your goal is to buy a house in 5 years, you might invest conservatively in bonds or balanced funds. If your goal is wealth in 20 years, stocks or growth funds may be more appropriate. Investing without a plan is like building a house without a blueprint. It's chaotic and likely to fail. A plan helps you stay on track, even when the market is volatile. 5. Letting emotions drive decisions. Emotions are one of the biggest enemies of beginners. Fear and excitement drive most decisions. When prices rise, beginners feel greedy and invest more. When prices drop, they panic and sell. This behavior leads to buying high and selling low, which destroys potential gains. Smart investors learn to detach from short-term emotions. They follow rules, strategies, and a plan, which allows them to make rational decisions even in volatile markets. For instance, during a market crash, many panic and sell. Experienced investors may see this as an opportunity to buy undervalued assets. Detaching emotions from investing creates opportunities rather than losses. 4. Ignoring costs and fees. Many beginners overlook fees, thinking they are negligible. Brokerage fees, fund management fees, and hidden charges can significantly reduce returns over time. Even a 1 to 2% fee on investments compounds and erodes wealth. For example, paying 2% annual fees on a $50,000 portfolio can result in tens of thousands of dollars lost over 20 years. Smart investors choose low-cost options, track fees, and understand the long-term impact of these small costs. Ignoring fees can silently drain your portfolio without you realizing it. 3. Trying to time the market. Beginners often believe they can buy at the lowest point and sell at the highest point. Timing the market is extremely difficult, even for professionals. Trying to do so often leads to missed opportunities or losses. Instead of timing, focus on consistent investing over time. Dollar cost averaging, for example, allows you to invest a fixed amount regularly, reducing the impact of market volatility. Even if the market fluctuates, consistent investing smooths returns over time. Trying to time the market often results in stress, missed gains, and poor long-term performance. 2. Failing to diversify. Putting all your money in one type of asset is a common mistake. Beginners often invest solely in stocks, crypto, or a single sector. If that investment drops, their entire portfolio suffers. Diversification spreads your money across multiple assets, sectors, and geographies. This balances risk and ensures losses in one area don't destroy overall wealth. For example, holding a mix of stocks, bonds, real estate, and cash reduces the risk of one market crash ruining your entire portfolio. Smart investors know diversification is not optional, it's essential. 1. Not understanding your investment. The most critical mistake is investing in things you don't understand. Beginners often buy complex funds, exotic assets, or even cryptocurrency coins without knowing how they work. They rely on social media tips, friends, or hype. When something goes wrong, they panic because they never understood the risk or mechanics. Smart investors only invest in assets they understand. Knowledge gives confidence. It allows you to stick to a strategy even when markets fluctuate. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.